Every crash in history looked obvious after it happened. The panicked faces on Wall Street in 1929, the digital ghost towns of the dot-com bust in 2000, the foreclosure signs that littered neighborhoods in 2008. In hindsight, the warning signs were always there, screaming at us from the headlines and the charts. But today, something unusual is happening in the global economy, a subtle shift that feels strangely familiar. And almost no one is paying attention. The music of the market is still playing, but the rhythm is off, and the silence between the notes is getting longer. Are we just enjoying the party, or are we ignoring the storm gathering just over the horizon? In 2008, millions of people woke up to a world that had changed overnight. Everything they thought was safe, their homes, their jobs, their retirement savings, was suddenly at risk. The foundation of the global financial system, which seemed so solid, crumbled in a matter of weeks. It started with a whisper, a few troubling headlines about something called subprime mortgages. Most people ignored it. It was complicated. It was happening somewhere else. But then the whispers became a roar. News channels flashed scenes of chaos on trading floors, and familiar bank names were suddenly on the verge of collapse. Today, the echoes of that crisis are still with us, but a new set of risks is quietly taking shape. The signs of a major correction often appear quietly, one headline at a time. Rising interest rates designed to curb inflation are putting pressure on businesses and consumers. Geopolitical tensions are creating supply chain disruptions we haven't seen in decades. And while the stock market continues to hit new highs, the volatility just beneath the surface tells a different story. The same sense of unease that preceded 2008 is back. The question isn't whether another correction will come, but whether we'll see it before it's too late. Markets don't crash randomly. They move in predictable cycles, driven by the most powerful force in finance, human emotion. It always starts with optimism, which slowly builds into excitement, and then full-blown euphoria. This is the phase where everyone feels like a genius. Stories of overnight millionaires are everywhere. Taxi drivers are giving stock tips. It feels like the rules of gravity have been suspended, that this time, it's different. But it's never different. After the peak comes denial. The first signs of weakness are dismissed as a healthy pullback, a buying opportunity. Then, as prices continue to fall, denial turns to fear. The fear slowly morphs into desperation, and finally, outright panic. This is when investors sell everything, regardless of value, just to make the pain stop. And then, at the point of maximum pessimism, when all hope is lost, the cycle begins again with capitulation and eventually, a slow return to hope and optimism. If you look at the chart patterns of 1929, 2000, and 2008, you see this exact emotional journey mapped out in candlesticks. Now, look at today's market. Where do you think we are in that cycle? In every major financial crisis, there is a hidden trigger, a single point of failure that brings the whole system down. In the year 2000, the trigger was the dot-com bubble. The market was flooded with internet companies that had no profits, no viable business model, just a .com in their name. Investors poured billions into them, believing the internet would change everything. It did, but not before the bubble popped, wiping out trillions in wealth. In 2008, the trigger was subprime mortgages. Wall Street created complex financial instruments built on risky home loans, packaged them as safe investments, and sold them around the world. When homeowners started defaulting, the entire global banking system seized up. Today, the next trigger is hiding in plain sight, and it could come from several places at once. Corporate and government debt levels are at all-time highs, far exceeding what we saw before 2008. Financial institutions are using more leverage than ever to chase returns in a low-yield world. We are in the midst of another massive tech bubble, this time centered on artificial intelligence, where valuations have become disconnected from reality. And all of this is happening against a backdrop of increasing geopolitical tension, which could disrupt the flow of energy, trade, and capital at a moment's notice. The system is more interconnected and more fragile than ever. The only question is which domino will be the first to fall. Few investors realize just how fragile the system has become. For over a decade, central banks pumped trillions of dollars into the economy, creating an ocean of easy money. This liquidity pushed asset prices to record highs and suppressed volatility, making investing feel easy and risk-free. But now, that tide of liquidity is going out. Central banks are aggressively tightening monetary policy to fight inflation. They are raising interest rates and shrinking their balance sheets, effectively pulling money out of the system. This is a process known as quantitative tightening, and its full effects are still unknown. What we do know is that liquidity is shrinking fast. The cost of borrowing is rising, and the cracks are starting to show. We're seeing unexpected bank failures, extreme volatility in government bond markets, and major currencies fluctuating wildly. These aren't isolated incidents. They are symptoms of a system under immense stress. The financial plumbing that keeps the global economy running is getting clogged. And when the plumbing fails, the entire house floods. The warning signs are flashing red, but many are still mesmerized by the short-term gains in the stock market, ignoring the foundational risks building right under their feet. During every market crash, a great transfer of wealth takes place. Some people panic, sell at the bottom, and lock in devastating losses that can take a lifetime to recover from. And some get rich. These moments of crisis are when fortunes are made. As the legendary investor Warren Buffett says, you should be fearful when others are greedy, and greedy when others are fearful. The key is not to predict the exact timing of a crash. That's impossible. The key is to be prepared for it. Preparation isn't about timing the market. It's about time in the market. It means understanding that these cycles are a normal, healthy part of a functioning capitalist system. They wash out the excesses and create incredible opportunities for those who remain calm and disciplined. The most powerful strategy is simple: manage your risk. Don't put all your eggs in one basket. Diversification across different asset classes, industries, and geographies is your best defense against a sudden shock in one part of the market. And most importantly, think long-term. Don't get caught up in the daily noise. Focus on your goals. Stay invested in quality assets. And let the power of compounding work for you over years, not days. Panicking is not a strategy. Patience is. History doesn't repeat itself, but it often rhymes. The names and the technologies change, but the human emotions that drive market cycles, greed and fear, are timeless. The next chapter of our financial history hasn't been written yet. We may be on the verge of a historic correction, or we might continue this bull run for longer than anyone expects. But one thing is certain: the signs are there for those who know where to look. The ability to see what's coming, to stay rational when everyone else is losing their minds, is what separates successful investors from the crowd. The future is uncertain, but your preparation doesn't have to be. And here's something most people overlook: crashes don't just test your portfolio, they test your character. When markets are booming, everyone looks smart, but when they fall, your true discipline is revealed. Will you let fear drive your decisions? Or will you stick to a plan built on logic, not emotion? Because the real winners aren't the ones who predict the crash. They're the ones who stay calm while everyone else loses their heads. This is why financial education is becoming more important than ever. In a world filled with noise, breaking news, and viral predictions, knowing how to separate facts from fear can save you not just money but years of stress. So take this moment to reflect. Are you prepared? Do you have a strategy? Do you understand the risks in your portfolio? These questions matter more today than at any time in the last decade. A storm might be coming, or it might pass, but preparation works in both scenarios. Because in the end, the market rewards patience, discipline, and clarity, not panic, speculation, or guesswork. So stay informed, stay rational, and stay ready. But there's one more thing you need to understand, something almost no one talks about. A crash doesn't start when the market drops. It starts when confidence breaks. Confidence is the invisible glue that holds the entire financial system together. It's the reason people put their money in banks, the reason companies borrow billions, the reason investors buy stocks hoping they'll be worth more tomorrow. And once confidence cracks, even just a little, the reaction spreads faster than any headline, any chart, and any economic model can predict. In every major crisis, there's a moment when people collectively say, something doesn't feel right. That shift in psychology, not the numbers, is what turns a correction into a collapse. And we're seeing early signs of that shift today. People are questioning the stability of banks, the sustainability of government debt, and the valuations of companies that have never turned a profit. This doesn't guarantee a crash, but it does guarantee one thing: the next few years will be a stress test for every investor on the planet. So here's the takeaway: don't fear the future, prepare for it. stay educated, stay diversified, and stay emotionally grounded. Because when everyone else is reacting to the last headline, you'll be planning for the next opportunity. And that's how you not only survive a crash, you come out stronger on the other side. But here's the truth most people never hear. You don't need to predict anything to build wealth. You just need a system that works in every market cycle. Because while crashes may seem like rare, once-in-a-generation events, smaller corrections happen constantly. And every one of them teaches the same lesson. The market rewards those who think long-term and punishes those who don't. So instead of asking, "When is the crash coming?" ask yourself something far more important. What will I do when it happens? Will you panic? Will you freeze? Or will you recognize that fear creates opportunities just as surely as greed creates bubbles? Think back to the last major downturn. People who sold in fear locked in losses. But the ones who stayed calm, the ones who kept learning, kept investing, kept planning, came out of it stronger, wealthier, and more confident. That's the mindset you need to develop now, before the next wave hits. Remember, every crisis in history eventually ended. Every bear market gave way to a bull market, and every period of chaos was followed by a period of growth. The real question is, who will you be when the cycle turns? Will you be the person who reacts out of emotion, or the person who acts with intention? Because in a world that feels more uncertain every day, clarity is your greatest advantage. Not predicting the future, but preparing for it. Make a plan, build your knowledge, strengthen your discipline, and when the rest of the world is panicking, you'll be the one who sees the opportunity hiding in plain sight. Thank you for watching, and don't forget to subscribe for more insights on finance.